Here we are again, another episode of In Good Company, where we take a look at what is happening to different companies. We analyze them just to give you information so you can make an informed investment decision on how to approach the market, because they say information is power, and is when you see the market going bonkers or perhaps going the other way around, that's when you understand how powerful information can be. And I don't come here alone. I come here with a city gentleman. I love to call him that. But before we go into that, what are we really talking about today? It's one of the oldest companies in the country. It's equally as old as Nigeria, and a company that has stood the test of time for that long. You should understand how very formidable a team they have, or how strong that kind of company is. And they are sitting pretty in the financial sector. AIICO Insurance, one of the biggest and heavyweight companies we have in this country, especially in the insurance sector. Ladies and gentlemen, that's what we're talking about today. AIICO Insurance. Is the future really bright? And I'm going to be asking the city gentleman I have with me, Idike Aja. Very much welcome to In Good Company once again.
Thank you very much, Frank.
Let's talk about AIICO Insurance. I'm really fascinated about the fact that they are 63 years old. That's a long time. And they have, meaning that they've been able to stand the test of time as regards building a strong and formidable institution. What's your take about the company that stood that long?
Yeah, it's quite well. They have done very well, and it's okay. Their financials have been impressive, and it's okay. At least having stayed that long means they are good, and they have continued to give investors good things to at least to be happy.
So their share price, their share price has really performed. What do you think about the performance of their share price lately?
Okay, generally the insurance sector so far this year has not done quite well, unlike last year. Last year, by the end of 2024, I think they had there are about 22 of them listed, and out of that 22, they had about 18 of them returned positive gains, while about 4 were flat. Unlike this year, where you have 6 advancers, then 7 flat, and 9 decliners. So you can see the disparity. In 2024, AIICO did very well. I think it was ranked 11th with 84% year-to-date gain. And this year, so far, is second behind NEM Insurance, and with year-to-date gain of 11.19%. So second. So relatively, it has done very well in 2025. And we believe that maybe, hoping that it can sustain the momentum it did last year.
What do you think are the key trends in the sector that can affect AIICO or impact them in general?
The
insurance sector.
The major trend, the Senate is as a bill on grants to increase their share capitalization.
That's right.
By NICOM. So.
But it's a long time coming, so we all expected that.
Where you have, I think, 10 billion for those in life insurance, and I think 15 billion for non-life, and 35 billion for reinsurance. But looking at AIICO has a very solid shareholders base. Unless maybe NICOM is saying it's going to do what CBN did for banks, where we don't want your reserves, we only want your core capital, which is your share capital and share premium. But even at that, if you look at AIICO's core capital, that is the share premium and the share capital, I think it's about a little above 18 billion, which is equally above the proposed capital requirement for both for life and non-life. I think they are in a pretty good shape to go. I think it wouldn't affect them, because even their share capital is their equity is about, I think, about 64 billion. So that is okay.
It's not going to affect them at all.
No, I don't think so. I don't think so.
Okay, so let's take a look at their profits, their profit earnings. You see, the profit growth has been, their growth as regards their profit has been decent, pretty decent. Look at what happened in 2024. But the big question a lot of investors are asking is, how sustainable can that be going into 2025 this year? We're already in 2025 as a matter of fact, but how sustainable do you think they can hold such growth?
Okay, let us look at it from this angle, especially 2024 financial year.
Okay.
They declared, I think, PBT, profit before tax of 15 billion thereabout, and profit after tax of 12 billion. Now, top line, they really did very well. The insurance revenue, I think, stood at about 1.8 billion.
Okay.
And they got it mainly from life insurance and non-life insurance. I think this one 55% and this one 51%. But the challenge there is that if you look at the insurance results, that is where they are having problem. They declared a loss of about 3.9 thereabout billion, the insurance result, because of claims. So you have claims of about 75 billion, claims and other expenses of about 75 billion. That's actually eroded their profits or the insurance revenue they made. So it is a big minus for them. Why they were able to sustain that level of profit, I think it's from their investment income, which they did about 45 billion, which is very good. But looking at their core business, they have not done very well. They have not done very well. As a matter of fact, when you add the insurance, reinsurance expenses and insurance finance net result, you have about 22 billion loss. They declared in 2024. So except the investment income, so they would have made a loss.
But they are projecting strong performance. They said they are projecting a very, very good 2025 and for a lot of investors. What do you have to say regarding that as well?
No, even their projection for the half year projection, they still look. If you look at the net insurance result, you still have about loss about 14 billion, which they are projecting. But if you look at their insurance results, I think they are looking at having about 6 billion, 6 billion, which is good compared to 2024, where they had about 3.5 billion loss. So, but in all, they still their insurance result is not okay. They're still projecting that they are going to sustain some losses from the insurance businesses. At least where they are relying is the investment aspect of it.
I was going to ask you about that, because if you look at their investment and their debt instruments, what do you think? What's your take about that?
Now, they might be able to sustain that.
Because future earnings might come in from there.
If they retain the position, what they did in 2024,
what did they do in 2024?
in 2024 they have the asset base I think it's about 400 billion. That is their balance sheet side. Now, if you break it down, you have the financial assets at amortized cost. That means the one they are holding, they are going to hold till maturity, which is about 128 billion thereabout. And if you calculate give and take, should give you about I think about 26% of the total balance sheet size.
Yeah, what we have left will
now,
be
what
like
that means is that now this asset we are holding at amortized cost, we are holding it till maturity, and the interest rate fluctuation does not really affect that. When you hold an asset in maturity, so like we discussed about commercial papers, if you hold it in maturity, the interest rate fluctuation might not really affect it. It's only maybe along the line if you want to sell that the interest rate, the higher the interest rate or the lower the interest rate might at least affect the yield.
Very true.
Now they have I think grew about 37% in 2024. That means they increased their holding in assets at amortized cost. Now, if you look at that one, what we call fair value to profit and loss, which that one is influenced by the fluctuation in the markets. And that one, I think they increased it by about 26% to about 178 billion, which is about 36% of the balance sheet size. Now, basically what they did is that, okay, fine, we know that this thing fluctuates. You understand? We know that this thing fluctuates, and the likelihood is that you might likely get higher or get lower depending on the interest rates.
But funny enough, there are lots of conversations around we having to. This year is going to be the year of we having to lower interest rates, the NPR. So obviously, everyone knows that NPR is most likely going to come down. Not too long ago, we saw what happened with NPR last month. It was a little bit around the same level. You get more or less like the MPC still holding the rate. So with all of this in view, don't you think that they already know their answers?
No, there's always a balancing act. You hold on the asset side, which if there's a decline in interest rate, definitely your income will come down. But on the liability side, the debt instruments you are holding automatically to the cost of fund will come down. So there's always a balancing act.
Sure. Okay, now on the final verdict, all these conversations is just about investors knowing whether to buy, sell, hold.
Okay.
What would you advise?
You see, when you
remember we're talking about a 63-year-old company.
Yes, when you want to buy anything you want to buy, whether stock or bond or treasury bills or commercial papers, the most important thing is to look at the intrinsic value, because what they quote in the market, what you see there, like now the share price is, I think as at close of trading yesterday, it was 1.59 kobo, which is even higher than what we call the net operating cash flow per share, which is about 120 naira. That means even though it is higher, but it is still reasonable.
Yeah.
Now, what you have to do is to find out what is the intrinsic value. And in investment, there are different methods you can use. Let us not go into that. But let us use one of them, the earning multiples, where you have the price earning ratio, you have the price to book ratio, you have the price to sell ratio. Of course, maybe later you now talk about the return on equity and the dividend yield. Now, if you look at those earning multiples, it shows that AIICO is relatively valued, possibly undervalued, because he's trading at 4.3. That means investors are ready to pay for every 1 naira in earnings. They are ready to pay 4 naira 30 kobo. That's what it means. That's what price earning ratio of 4.3 means.
Yeah.
That for every 1 naira in earnings, investors are ready to pay 4 naira 30 kobo.
Yeah.
Now look at the price to book ratio, which is at I think 0.9. It's showing that the share price is lower, relatively value lower to the book value.
Yeah.
That means investors are getting the share price lower compared to the book value.
Yeah.
The same thing, if you look at the price to earning ratio, which is about 0.39 thereabout, so that investors are not really pricing in the growth in the company's revenue.
That's right.
So if you put these three together, it shows that AIICO is relatively undervalued.
Okay.
Compared to the book value, compared to the revenue. So for me, it is the ratios, the metrics show that it is undervalued.
You've heard from Idika, city gentleman. He's been there and has done that, and is the best person to advise you as regards whether to buy, sell, or hold. And he's told you about taking a look at their intrinsic value. Look at the numbers. That is what it means when we say do your own research or carry out proper due diligence before investing in any asset class. And that's why we have a show called In Good Company.
But you have to look at before you even conclude. Apart from the numbers that the metrics are saying, you equally have to look at the risk. What are the risks you are inherent risk you see them.
That's right.
Now I've mentioned that one, AIICO is relying heavily on investment income. From its core business, they are not doing very well. Investment income. Like now you've mentioned, if there's any serious fluctuation in the market in terms of interest rate, it will affect their interest income.
That's right.
And unless they boost their earnings from their core business is really not giving, because they sustain about 22 billion loss from their core business. That is from the insurance. They only recover from their investments aspect of the business.
Thank you very much,
which is to me is a risk.
Yeah.
If you look at that aspect,
you
can say, okay, let me hold and watch out what they are going to do. Because they have given us their forecast that their insurance business is going to come up, that they are going to at least recover from the loss they made in 2024.
Yeah, perhaps we might have a very, very good investment landscape and 2025, and they might make a truckload of money from their as regards their investment income. So
sure. Secondly, too, it is.
Remember that this year is a lot of.
AIICO is more or less like that what we call value and growth stock.
Yeah.
So it's more or less like a value stock, because any stock that pays dividends is good for income oriented.
That's right.
And the dividend yield currently is about 3.4. I think 3.14.
So
if you add it to the capital gain, which is 11.19, you'll now be having a total shareholder return about 14 points. There are 14%. Let's say 14%.
Yeah.
Which relatively it is okay. And the good thing is that it is a dividend paying stock for income oriented investors who will be interested in just getting dividend and cashing out. So I think the last dividend paid about 5 kobo, and we expectedly they might declare dividend for 2024. I think
you've heard from him, and I need I say much? I don't even have to say anything. As a matter of fact, he said everything that you need to understand regarding the company we're talking about, which is AIICO. And that's it on this episode of In Good Company. My name is Frank Fagball, and you've heard from Idika Aja, who's a city gentleman, he's a chartered stockbroker and a financial analyst. Until next week, where we'll meet you again and take a look at some other companies making giant strides in Nigeria's capital market. Cheers.